Hello YouTube, welcome to Accounting 101 with T. Today we are doing balance sheet from our past paper, which is from the February-March 2018 past paper. We are going to be doing our question 4, which is the balance sheet. So we are also going to do the notes to the balance sheet, which is required to be done, which is our ordinary share capital and the retained income note, also the balance sheet. So we are going to be using our Excel spreadsheet as our answer sheet. These tables here were drawn from the answer sheet of the past paper, and then these two amounts, these bold amounts, were already there on the answer sheet. So we are required to do everything from assets to the equity and liabilities. Only these were recorded, so we are going to record and calculate everything on this Excel spreadsheet. So without any further ado, let's start with our video. Let's start with our tutorial. So number 1, ordinary share capital. We are going to look at our share capital, which is our information B. Even before doing this, let's answer these questions first. 4.1.1 income statement. From our column B, income statement goes with the alphabet C, which says it reflects the profit and loss of the company for the year. And then balance sheet. The balance sheet goes with alphabet E. It reflects the net worth of the company. And then 4.1.3, it goes with alphabet D. It reflects the effect of the operating, financing and investing activities on the cash resources. And then 4.1.4, director's report. It goes with alphabet A. It is an explanation of the operations of the company during the financial year. And then last, which is our independent audit report, which is 4.1.5. It goes with B, alphabet B. It reflects whether or not the company, or it reflects whether or not the shareholders can rely on the financial statements. So I guess we are done with our 4.1. So forward we go to our 4.2. So for the ordinary share capital, we are going to be looking at our information B, share capital. The business has an authorized share capital of 6 million shares. 70% of the shares were in issue on 1 July 2016. So our financial year ends on 30th June 2017. So this means that 70% of the shares that were in issue on 1 July 2016 were shares issued at the beginning of the year. So 70% of these shares, of 6 million shares, were in issue at the beginning of the year. Looking at our books, ordinary share capital is on 1 July 2016. It was 3,150,000. This 3,150,000 represent our 70% of the shares that we issued on the 1st of July 2016. So we are going to take our authorized shares, 6 million, record it all under the authorized shares, which is 6 million, and then go to the shares issued at the beginning of the year, which is our 70%. We have already read that out. We are going to take out the 70% of the 6 million. 70% times 6 million. We are going to get 4,220,000. So we have to indicate what is this for. We are going to say shares issued at the beginning of the year, issued issued at the beginning of the year. That's right. Shares issued at the beginning of the year. Let's just expand that. Okay. And then bullet number 3. 60,000 ordinary shares were repurchased from a disgruntled shareholder on 1 December 2016. The company paid R3.50 per share. This was paid and recorded on 1 December 2016. 60,000 ordinary shares were repurchased from a disgruntled shareholder on 1 December. The company paid R3.50 per share. This was paid and recorded on 1 December 2016. So here's what we normally do. We normally don't use the R3.50 that the company paid to repurchase the shares. So the price that we use is the average price per share that we have to calculate ourselves. So we are going to take, before even calculating the buyback average price, let's first record the amount at the beginning of the year of shares issued at the beginning of the year. We were given the amount, which is 3,150,000. We are going to say 3,150,000, and then we are going to say a negative 60,000 shares, a negative 60,000 shares, or should I, let me just take out the negative sign and just say 60,000 shares. And then these were the shares bought back. These were the shares bought back. We have to calculate at how much were they bought back. At how much were they bought back. So we have to calculate the average price. So to calculate the average price per share, it's the value of our shares divided by the number of shares issued. So we are going to take our 3,150,000 divided by the 4,200,000. So we are going to take only this information, because there were no shares issued during the year. If there were shares issued during the year, we were going to say the shares issued at the beginning of the year plus the shares, the value of the shares issued during the year, divide by the shares issued at the beginning of the year and the shares issued during the year. We were going to take these amounts here divided by the shares that were issued, and then we were going to get our average price per share. So we are going to say equals to sign this divide by this. We are getting our average price per share as 0.075 cents. So this is the price that we are going to use to buy back our shares from the shareholder. We are going to include this 0.75. So on this column we are going to calculate how much do they cost. All in all, we are going to say 60,000 times 0.75, which is giving us 45,000 rands. So we are done with our ordinary share capital. What's left for us is to balance everything. We are going to balance our shares column. We are going to say equals, not this one, we have to balance this one. We are going to say equals to sum To my matriculants, no, it's not sum. We have to say equals to 4,200,000 minus 60,000 shares. It's 4,140,000 shares at the end of the year. We all know that this amount is a negative amount. If you are writing an exam, these shares should be in brackets. Also, this amount should be in brackets. So because I'm using an Excel spreadsheet, I'm not going to put it in brackets because it's going to be hard for me to calculate it. I'm just going to say minus, because if it was in brackets, it was going to say minus and then minus 45,000, which is a negative times negative is positive. So it was going to add together with the 3,150,000. So 3,150,000 minus 45,000 is 3,105,000. It's 3,105,000. This is our ordinary share capital at the end of the year. This is shares 4,140,000 shares issued at the end of the year. Issued at the end of the year. These are the shares issued at the end of the year. This amount, we are going to take this amount and record it under our ordinary share capital on our balance sheet. It's going to be equals to this amount, which is 3,105,000 rands. So going to our retained income note, we are going to look at our retained income note at the beginning of the year. Our retained income note at the beginning of the year, which is 1 July 2016, it's 874,000 rands. We are going to take it as it is because we are given. This is a given amount, 874,000 rand. 874,000 rand. We are going to say balance at the beginning of the year. It's 874,000 rand. It's 874,000 rand. It's 874,000 rand. So here we are going to be looking at our net profit after tax. Net profit after tax. So our information for tax is alphabet F. Income tax for the year amounted to 408,800 rands. This was calculated at 28% of the correct net profit. So what they mean with this information is that this 408,800 rands represents the 28%. So this is the 28% of the total income tax. So this was calculated at 28% of the correct net profit. So we have to calculate the net profit after tax. So we are going to take the 408,800, 408,800,000. We are going to say net profit after tax. It's going to be in brackets. We are going to say in brackets we are going to take our 408,800, 408,800 times, so times what? Times 78%, because we are looking for the 78%. We are not looking for the 100% of the net profit, before tax. We are looking for the net profit after tax. The net profit after tax is the 72,000. I mean, it is the 72%, because we would have already taken out the 28%. So 28 plus 72 is 100%. So we are actually looking for the 72% after tax. So we are going to say 72 over our 28%, because our net profit, this amount represent the 28%. So it's what we have times what we want, 72%, over what we have, which is then going to give us our net profit after tax. Our net profit after tax. So we are going to calculate it properly here. We are going to say 408,800. It's 408,800. 408,800 times 72 over 28 over 28, which is then going to give us 1,051,200 rands. So this represents our net profit for our net profit after tax for the year. So our next transaction is going to be our shares bought back, which is 60,000 shares bought back. So on our retained income note, we all know that when we are recording the shares bought back on the retained income note, we are not going to use the average share price or use the price that the company paid to buy back these shares. We have to take the difference from 3.50 and 0.75 75 cents. So we are going to say 60,000 shares bought back at 60,000 shares bought back at R2.75. So we are going to say R2.75 in brackets. I'm going to show you the calculation. We are going to say 3.50 minus 0.75 cents, which is giving us the R2.75. So we are going to go to our calculation, say 60,000 shares minus the R2.75. 2 rand times, not minus, it's times 2 rand, 75 cents, which is giving us our 165,000 rands. We all know that this amount is always in brackets. This amount is always in brackets. It's a negative amount because we are buying back shares as the business. So under here, this is going to be our dividends. This is our dividends, which includes our interim dividends, and our final dividends. It's our interim dividends and final dividends. Most of the time we are given calculations to calculate our final dividends. We are sometimes given calculations to calculate our interim dividends. So in this question paper, we only have to calculate our final dividends of 22 cents per share, we don't have to calculate our interim dividends because we were given on our they were there on our books, which is on our books ending 30 June 2017. So it's dividends on ordinary shares, which is interim dividends. It's 630,000. We are going to record it as it is, 630,000. 630,000. So as for our final dividends, we have to calculate it ourselves, the final dividend. So information C, a final dividend of 22 cents per share was declared on 30th June 2017. Only shares in the share register qualify for final dividends. So without knocking our heads, we are going to say 0.22 cents. We all know that the 22 cents represents, it's 0.22. It's 0.22. 22 cents times 4,140,000, because they say only the shares in the share register qualify for final dividends, which means that these shares are the shares in the share register at the end of the financial year. So we are going to say equals to 0.22 cents times 140,000, which is then giving us 910,800 rands. So we are going to add these two to get our dividends. We are going to say equals to sum of our interim and final dividends, which is then giving us 1,540,800. So to get our balance at the end of the year, balance at the end of the year, our balance at the end of the year, we are going to say 874,000 plus our net profit, which is 1,051,200 rands, minus the 165,000 rands because it's for shares bought back, and then minus our dividends, which is 1,540,800 rands, which is then going to give us 219 rands 400 to 219,400 rands. This amount is going to be taken to our balance sheet. We are going to take this amount as it is to our balance sheet, which is giving us 219,400 rands. So we are already done with our shareholders equity. We are going to say equals to sum of these two. We are going to add them together, the ordinary share and the retained income, to get our shareholders equity. So our shareholders equity is 3,324,400 rands. Our shareholders equity is 3,324,400 rands. So let's continue to our balance sheet and our adjustments and information. So we are going to look at our assets. Let's first look at our assets. As per our information, our fixed deposit is 380,000, which is already recorded, and then our fixed assets at carrying value, it's a question mark. So we will therefore skip to other assets, which is our trade and other receivables and cash equivalents. We will then go back to the fixed assets. We are going to check on our information whether this is going to be a balancing figure, or we do have information regarding the fixed or tangible assets. So let's continue. So Looking at our information, we have we have already dealt with these two. We are going to look at our debtors control, which is 317,000 rands. Debtors control goes to our trade and other receivables. Our debtors control goes to our trade and other receivables. So in brackets, debtors control goes to our trade and other receivables. It's how much is it? It's 317,000. It's 317,000. 317123. On our information, we are required to create a provision for bad debts. So information D, provision for bad debts is set at 5% of outstanding debtors. So debtors control represent the amount that our debtors are owing us. So this amount, in other words, this is the amount that we should receive in due time from our debtors. So this is a receivable amount. This represents our good debtors, which is our outstanding debtors that haven't paid us. We are going to receive it in due time. So we are going to take the 5% of the 317 because the provision for bad debts is set at 5% of the outstanding debtors. Our outstanding debtors is our debtors control. So to do the provision for bad debts, we are going to save 317,000 times 5%. We are going to calculate it right here. We are going to say 317,000 times 5%, which is then giving us 15,850. So on our trade and other receivables note, we always take out the provision for bad debts. So it's always our balance minus the provision for bad debts, which is 15,850. 15,850. We always take out our provision for bad debts. We take it out of our debtors control to get the amount for debtors control. So yeah, let's continue. We are going to look if we have any accrued expenses or prepaid expenses from our information here. By the look of things, we don't have any of that. Let me check here. Insurance included an annual premium of 31,800 rands paid for the period of 1 October 2016 to 30 September 2017. So this is our prepaid expense. We as a business have paid an insurance, an annual premium of 31,800 for the period of 1 October 2016 to 30th September 2017. So we are going to record the prepaid expense, meaning that the prepaid expense means that an expense paid in advance. So we are going to take that amount that we paid in advance, record it under our trade and other receivable note, because the amount is receivable. We have to receive. They have to give us back the amount, which is the amount for July, August, and September, which is for 3 months. So we are going to say 31,800 divided by 12. We are going to take our 31,000. We are going to say 31,800 divided by 12, which is giving us 2,650 rands. This means that the 2,650 rands we paid it for 12 months. We paid it from October, November, December, January, February, March, April, May, June, July, August, and September. So our current financial year ends on the 30th of June 2017. So this means that the other months after the 30th of June 2017, this is the months are out of our current financial year. So as a business, we shouldn't pay for expenses out of our current financial year. So we have to take our money, which is, we are going to say 2,650 rands, 2,650 rands times 3 months, because it's July, August, September, it's 3 months. So this 7,950, we are going to add it on our, note, which is trade and other receivables. It's 7,950. 7,950. This 7,950 represents the what should I say? It represents the prepaid expense, the expense paid in advance. We are supposed to receive it back as a business. So that's our calculation for the prepaid expense. We are already done with the insurance information. On our income statement, this amount, the 7,950, the 7,950 is added on our, the 7,950 is subtracted from our, let me do this just quickly. It keeps on disappearing, this thing keeps on disappearing. Let me just do this. So on our income statement, we, this 7,950, we subtract it from our insurance expense. We subtract this amount on our income statement, and then on our balance sheet we add it to our trade and other receivables note. So I think we are done with our trade and other receivables note. Let me just double check. I think we are done with our trade and other receivables note, because we don't have any other accrued income. Yes, I think we are done. Even on our information, we don't have anything affecting our trade and other receivables. We are going to calculate this. We are going to say 317,000 minus 15,000, 15,850, 15,850. I hope my amounts are correct. And then we are going to add the 7,950, which is then giving us 309,100. For cash and cash equivalents, we have to check our cash, which is our bank, which is favorable, or yes, which is favorable. We record the bank that is favorable. Favorable means that it is a positive balance, which is the debit balance. It's 250,700. 250,700. Favorable balance means that the balance is a debit balance for the bank account. So we are going to say our bank, it's 250,700, 250,700 plus, let's see if we have anything affecting our cash and cash equivalents. Looks like we don't have anything because we don't have any petty cash, we don't have cash float or anything. So yeah, we are done. Yes, we are done with our cash and cash equivalents. So our cash and cash equivalents is going to be 250,700. There's no calculation for it, we are going to record it as it is, 250,700. And then we are going to add everything together to get our current assets. We are going to say equals to sum. We are adding everything together to get our current assets. Our current assets is 1,037,000 rand, 800 rands. It's 1,037,800 rands. So continuing, we can't totalize our total assets because we don't have our fixed assets. As not having our fixed assets, it makes us not to have our non-current assets. So we have to say non-current assets plus current assets, which is then going to give us our total assets. So we are going to take our, let me check. Moving forward, we are going to go to our non-current liabilities, which is our long-term loan, which is our loan from Helping Bank. It is 302,400 rands. So we have information affecting our loan. So here it is. The loan statement from Helping Bank reflected the following: balance on 1 July 2016, 480,000 rands. Repayments during the financial year, including interest, it's 177,600. Interest is capitalized. The balance on 30th June 2017 is already there, which is 302,400 rands. So on this 302,400 rands, the interest capitalized was not included on that 302,400 rands. As you can see here, repayments during the financial year, including interest, it was taken out with the repayments during the financial year. So this interest of 57,000 rands was taken out of our loan, which is from our, it was taken out from with the repayments during the financial year. So this 57,600 rands, it is already in our repayments. So here's the thing, here's a catch. We have to, as a business, we have to always include our interest, because these are the interest that we are paying to our creditors. So we have to add back the 57,600 rands, add it back to our loan, which is 302,400. So check this. This 480,000 minus 177,600, it should give us this 302,400 rands. So we are going to say equals to sign 302,400, 302,400 minus our repayments of 177,600, 177,600. it shouldn't be this. It should be our balance at the beginning of the year, not at the end of the year. Our balance at the beginning of the year, it's 480,000. Yes, we should take our 480,000. We are going to see our 480,000, then giving us the 302,400, which is the one I'm talking about. It is the balance at the end of the year. So we have to add back our interest capitalized, which is the 57,600 rands. We are going to go to our non-current liabilities loan. It's our loan from Helping Bank. We are going to say 302,400 rands plus the 54,000, is it 54, plus the 57,600, and then we have to take out again the 40,000 of the loan, which will be paid back in the next financial year. So this is our current portion of the loan. This is the loan that will be paid in the next financial year, as it is explained here. So the 40,000, we are going to take it out from our loan because we are going to pay it back the next financial year. We are going to record this 40,000 under our current liabilities as a current portion on loan. So we are going to say minus 40,000. On our calculations, we are going to say 302,400 plus 57,600 minus 4040,123. It's 320,000. Our current non-current liabilities is equals to this amount. And then under our current liabilities, here we are dealing with our trade and other receivables. Trade and other receivables. We always have our trade and other receivables under our current liabilities. Our trade and other receivables consist of creditors control. Our creditors control, this is the amount that we owe to our creditors, that we have to pay to our creditors. It's 239,800. We are going to take it as it is, 239,800. Is it 800? Yes, it is 800. 239,800. So we also have to check if we have any accrued income, accrued expense or prepaid expense. So prepaid expense meaning we are going to take our prepaid income, not prepaid expense. Prepaid income, which is income received in advance, we have to take it back to those who paid us this amount in advance. We have to take it out. So we are going to add the 6,600 rands, add it to our trade and other receivables. It's 6,600 rands. We are going to 6,600. We are going to add it to our trade and other receivables. And then under our trade and other payables, so it's our SARS, our income received in advance, our accrued income, accrued expense, and yeah, those are the particulars that always go into our trade and other receivables on our balance sheet. So forward we go, I think we have already dealt with anything that goes into our trade and other payables, because our information ends on information F. Okay, so we are going to close off the trade and other receivables. It's trade and other payables, not receivables. Payables. Forgive me for the error. Payables. Trade and other payables, which is then we are going to say equals to 239,800 plus 6,600. It equals to 246,400. And then we are going to record our dividends, which is our final dividends. We are going to say shareholders dividends. Let's just put it like that way. Dividends. Shareholders dividends. We always record the final dividend on our balance sheet. We always record our final dividends on our balance sheet. So we also have to check any other accounts affecting our current liabilities. So next we are going to look at our SARS income tax provisional payments, and then we are going to look at it with our 408,800 rands. So here's what we are going to do. So for SARS income tax, we are not recording this 390,000 as it is on our balance sheet because it has already been recorded. So what is required of us to do is that we have to show how much must be recorded so that this amount can reach this amount of 800 rands. So we are going to say SARS income tax. On our SARS income tax, we are going to say 408,800 minus 390, which is for the provisional payments. It's 390,000 rand, close brackets. On our calculation, we are going to take it as it is 408,390 408,800 minus 390,000, which is then giving us 18,800 rands. So as I said before, we have to show how much should it take for this amount 390 to get to 408,800 rands. So this means that during the year, sometime during the year, we as a business, we paid SARS 390 rands instead of paying 408,800 rands for the year. So this shows that our income tax for the year was supposed to be 408,800 rands. so it was 390 rands. So we are going to take it as it is, as we did in our calculations. So you take the provisional payment minus the income tax that you have, which is going to be the amount that is going to be recorded on your balance sheet always. So last but not least, we are going to take our current portion on loan. Current portion on loan. Current portion on loan. Our current portion on loan, it is the 40,000 that will be paid in the next financial year that we subtracted from our loan. So it's going to be our 40,000 rands. 40,000 rands as it is. So we are done with our current liabilities. We are done with our current liabilities. We are done with our non-current liabilities, also our shareholders' equity. So this means that we can get our total equity and liabilities, so that we can get, we all know that total assets is always equal to our total equity and liability. So we are going to say equals to sign sum to this whole column, which is 1,216,000. So now we are only doing this. We are going to say this plus 320,000 plus 1,216,000, which is then giving us 4,860,400. So we are going to take this 4,860,400, record it on our total assets column, because we all know that total assets are equal to total equity and liabilities. If you know our accounting equation. So to calculate our non-current assets, because when we calculate our total assets, which is this amount, we always say total assets plus we always say non-current assets plus current assets, which is then giving us our total assets. So now we only have our total assets and current assets. So now we are going to say our total assets minus our current assets. We are going to say 4,860,400 minus the current assets, which is 1,037,800 rands, which is then giving us our non-current assets. Our non-current assets is 3,822,600 rands. So we are going to say 3,822,000 minus 380. We are going to say equals to 3,822,000 minus 380,000 rands, minus 380,000 rands, which is giving us our 3,422,600 rands. So we are done with our balance sheet. We are done with our balance sheet. We are done. Yeah, it looks like we are done. So thank you for getting up to this point, reaching up to this part of the tutorial or video. Thank you. Please don't forget to subscribe, like, share and comment. And if you have any questions, don't forget to drop them in the comment section, and then I'll take time to answer them, to answer every question. So thank you very much.